When it comes to financing your business, you have two main options: debt or equity. But what are the differences between the two, and how do you know which is right for you? Equity finance is the process of raising capital by selling shares in your business. An investor will make a return on this investment by eventually selling their shares or by receiving a share of your company's profits. If you've taken out a mortgage, car or student loan, you're already familiar with debt financing. Essentially, you'll borrow a lump sum which you then pay back over time with an agreed upon amount of interest. When you're exploring your options, there are 6 main points to consider. With debt finance, you'll repay the money plus interest over a set period of time, whereas equity finance carries no repayment obligation, so more money can be channeled into growing your business. Essentially, equity financing means that an investor will own a share of your business, whereas with debt finance, you retain full ownership. However, it's worth bearing in mind that an investor often brings added value to a business with their expert guidance and industry contacts. A lender may ask you to pledge an asset as security for the loan, such as property or equipment. If you can't repay the loan, the lender may claim that asset to get their money back. With equity finance, you don't need to put up collateral. If you're a startup with no trading history or physical assets, it can be more difficult to secure debt finance. But equity investors are often willing to back companies that are considered more high risk by a lot of debt providers. An equity investor might ask for a seat on the board. This means they'll have a say in the overall direction of the business, whereas a lender has no ownership and therefore no involvement in business decisions. If you're in a hurry to raise cash for your business, equity finance probably isn't your best option. It can take a while to find the right investor, and there's a lot more legal work involved. Debt finance is usually more straightforward, and you often receive the funds in a matter of weeks or days from some providers. Ultimately, the financing method you choose will depend on your individual situation, including the nature of your business and the path you're on. Also, you don't always have to choose between the two. Many businesses opt for a combination of debt and equity together. This allows you to reap the benefits of both while balancing the needs of your business. What's important is that you explore your options before embarking on this journey.